All right, listen, something major just went down in silver. In the last 24 hours, silver is down about 2.6%. It went from roughly $84 an ounce to $81.95. That's a drop of about $2.21, basically overnight. And if you're sitting on, say, 500 ounces, maybe physical, maybe in an account, that move alone is roughly $1,100 of value that just vanished in a day. That's not normal noise, and that's the kind of move that tells you something under the surface just changed. Meanwhile, gold is only down about 0.6%, sitting around 50.0151. So the question is obvious. Why is silver getting hit harder than gold? And is this the beginning of a bigger flush? Because what you're seeing isn't the mainstream explanation. 3 critical events just collided, and it set silver up to fall harder, faster, and in a way that tends to scare people out at exactly the wrong moment. Stay with me, because by the end of this video, you'll have a clear framework for what this move probably was, what could come next, and the one thing I'm watching that decides whether this is a fake out or the start of a deeper drop. This isn't just normal market behavior. Here are the 3 factors that converge today. First, silver just did what I call a trapdoor move. That's when price doesn't grind down slowly. It drops through levels fast enough that people don't have time to think. They just react. When a market drops 2+% in a short window, it's rarely a bunch of calm, long-term investors deciding to sell at the exact same time. It's usually positioning getting forced. That can be leveraged traders getting tapped out. It can be systematic funds reducing exposure. It can be stop losses cascading. And silver is notorious for this because it's smaller and more volatile than gold. So when fear hits, silver tends to move like the high beta cousin of gold. Second, you've got a macro backdrop that's not exactly friendly to metals right now. The Fed narrative, at least in the way it's being talked about in markets, has this hold rates steady, keep policy tight until inflation is clearly done vibe. Even if you don't follow the Fed closely, here's the simple mechanism. When investors think rates stay higher for longer, cash and short-term yields look more attractive. The dollar often holds up better. And metals, especially silver, can get smacked because they don't pay interest. Gold can sometimes resist that because it's treated like monetary insurance. Silver doesn't always get that luxury because it's part monetary metal and part industrial metal, so it can get hit from both sides. Higher rates pressure plus economic growth fear pressure. Third, this is the part most people ignore. Silver is a positioning market. It's a leverage market. A lot of the paper silver world is futures, options, and highly liquid vehicles where traders can use leverage. That means when price drops, it can trigger forced selling. Think of it like this. If you're driving calmly, you can slow down smoothly. But if you're driving on black ice, one small slip turns into a spin. Leverage is the black ice. So when silver slips, it often doesn't just slip, it slides. Now connect those 3 things: a trapdoor, move through key levels, a macro headwind narrative, and leverage forcing liquidation. That's how you get a 2.5% drop that feels like it came out of nowhere. And the stakes are simple. The next phase determines whether this was capitulation, meaning the weak hands got flushed, or whether it's the start of a deeper move where the market hunts for a lower level that actually attracts real buyers. Now, I analyzed the price action this morning, and here's what jumped out at me. Silver didn't drift down gently. It dropped. That matters. Because when a market falls fast, it creates 2 different emotions at the same time. One group panics and sells. Another group freezes and says, I'll wait for it to stop. And the problem is, by the time it feels safe, the best opportunity is usually already gone. So here's how I think about it in real terms. Silver was hanging around the mid-80s, and now we're at 81.95. That's the difference between everybody's confident and everybody's questioning. And silver is a level-driven market. Even if you've never used technical analysis in your life, you already understand it. You understand it because you're human. Humans remember round numbers. Humans remember recent highs. Humans remember the price they almost bought at. So when silver loses a few dollars quickly, the crowd starts anchoring. They go, wait, but if it can drop $2 in a day, what if it drops 5? That's how narratives form. And when narratives form, price can overshoot, down or up, because people stop reacting to price and start reacting to fear. Now, I'm not here to tell you this is definitely the bottom. Nobody knows that. We might see more downside first. But I am telling you that moves like this are usually about positioning getting cleansed, not the physical world suddenly changing overnight. And that brings me to the bigger question. Is this drop telling us silver demand is collapsing? Or is this a paper market flush where the physical and longer-term fundamentals don't change nearly as much as the price action suggests? Now let's talk about the fundamentals, the real supply and demand picture, because this is where a lot of people get completely misled by a one-day move. Silver is not just a shiny metal. Silver is an industrial input. It gets used up. A lot of it doesn't come back quickly because it's embedded in products, electronics, energy systems, industrial applications, things that don't get melted down like jewelry. So when you see silver drop hard, you have to ask, did the world suddenly stop needing silver? Did solar installations suddenly vanish overnight? Did electronics production stop overnight? Did industrial demand just fall off a cliff in 24 hours? No. Which is why these sharp drops are so often about money flows, not the real-world need for the metal. And here's a key concept that matters a lot right now. Silver supply doesn't respond quickly. A huge portion of silver production is tied to other metals. Silver is often a byproduct, so even if silver price moves, supply doesn't instantly surge the way people assume. That means the market can swing wildly because it's trying to balance short-term paper flows on top of a slow-moving physical reality. Now, why do I bring that up today? Because if this move is mainly a flush, the setup afterward can be very different from what your emotions are telling you right now. When you get a fast flush, it can do two things. It can scare out weak hands, and it can hand a better price to patient buyers. And that's why silver moves are so psychologically brutal. They're designed by the structure of the market to make you feel stupid either way. If you buy, it drops and you feel stupid. If you wait, it rebounds and you feel stupid. The only way to handle that is not to predict perfectly, but to think in scenarios and time frames. Short time frame, you respect volatility. Long time frame, you respect supply, demand, and monetary conditions. And speaking of monetary conditions, gold being down much less than silver today matters, because it suggests that whatever is happening is hitting risk and leverage more than monetary hedge. That's a clue. Now let's talk institutional behavior, because this is where you can get the cleanest tell of whether today was panic or positioning. Institutional money saw this coming, not because they know the exact tick-by-tick move, but because big money doesn't wait for headlines. They position around probabilities and regimes. And one of the cleanest examples of that lately has been what's happening in China. You've got continued official gold buying being reported, and you've also had strong flows into China gold ETFs recently. That matters because it shows you something. Even with big prices, there's still a bid for monetary protection. Now here's why that connects to silver. When gold has institutional support, it can act like an anchor for the whole precious metals complex. Silver can deviate violently in the short run, but it often gets pulled back into the broader narrative later, especially if the macro environment shifts toward easing, currency debasement fears, or geopolitical risk. And there's another institutional angle that people miss. Sometimes the most bullish thing that can happen in a bull market is a brutal correction, because it resets leverage. If too many people are piled in, the market becomes fragile. It only takes a small push for a cascade. But after the cascade, the market can become stronger because the forced sellers are gone. That's why today's flush is such a big deal. It might be a warning sign, or it might be the market getting healthy again by clearing out the excess. The key is what happens next. Do we see follow-through selling where silver can't bounce at all? Or do we see stabilization where every dip starts getting bought? And the people who will reveal that answer aren't the loudest accounts online. It's the way price behaves after the shock. Does it keep bleeding, or does it start rejecting lower prices? That's the real tell. We've seen this exact pattern before. Back in early 2020, when fear hit markets and liquidity became king, silver didn't behave like the safe haven people expected. It behaved like a volatile asset that got sold to raise cash. Silver dropped hard, fast, and emotionally, and it felt in the moment like, this is broken. Then the dust settled. And when the regime shifted from panic to stimulus, silver didn't just recover, it launched. What was the sequence? First came the liquidation phase. That's where everything gets sold because people just want dollars. They want safety. They want margin relief. Then came the stabilization phase. That's where the selling slows, and you start seeing that the market can't make new lows as easily. Then came the repricing phase. That's where the market starts to realize the response to the crisis, money printing, stimulus, rate cuts, changes the long-term math. Now, I'm not saying we're about to replay 2020 tick for tick. History never repeats perfectly. But the psychology is eerily similar. A sharp downdraft that feels like this shouldn't be happening, followed by a battle over whether that move was forced selling or genuine demand destruction. And here's the key difference today. In 2020, the policy response was immediate and massive. Rates went down, stimulus hit, liquidity flooded the system. Right now, the policy tone is more cautious. There's still this idea that rates might stay higher for longer unless inflation clearly breaks. So the path may be choppier, but the underlying reason people own metals hasn't disappeared. The reason is trust. Trust in purchasing power, trust in currency stability, Trust that the financial system will behave in a predictable way. When that trust gets questioned, gold usually reacts first. Silver often reacts second, and it reacts harder. So when you see silver flushing like this, you don't just ask, is silver broken? You ask, what kind of market are we transitioning into? Because if we're transitioning into a market where growth is wobbling and policy eventually has to ease, silver's volatility can flip from pain to opportunity. And if we're transitioning into a market where policy stays tight and the dollar stays strong, silver can stay under pressure longer than people expect. That's why this moment matters. Not because today decides everything, but because the next couple of moves reveal the regime. Let's make this personal, because if you're watching this, you're not a hedge fund. You're trying to protect your money, maybe grow it, and not get blindsided. So let's put real numbers on it. If silver dropped about $2.21 in a day, here's what that means depending on what you hold. If you've got 100 ounces, that's about $221. If you got 500 ounces, that's about $1,100. If you've got 1,000 ounces, that's about $2,200. And that's just from a one-day move. Now imagine that kind of volatility happening multiple times in a month. That's where people emotionally break. That's where they either overtrade, panic sell, or swear off the asset completely. But here's the twist. That emotional breaking point is often where longer-term positioning gets built. Not because the price has to go up tomorrow, but because the people who can handle volatility start accumulating exposure in a more thoughtful way, while the people who can't handle it get shaken out. And I want to be very clear here. This is not me telling you to buy anything or sell anything. This is me telling you the truth about how these markets function. Silver is a market that punishes certainty. If you come into silver thinking it can't go down, it will humble you. If you come into silver thinking it will never go up, it will humble you too. So the smarter way to think about this is, what's your time frame? What's your exposure size? And can you emotionally survive the volatility? Because if you can't, you'll end up making decisions at the worst possible time. And I've been tracking this market for years, and I can tell you something simple. The biggest losses usually don't come from being wrong on the long-term thesis. They come from getting forced out or emotionally shaken out during the flush. Today is exactly the kind of move that tests that. Look, the question isn't whether we'll see more volatility. The math is clear. Silver is sitting around 81.95. Gold is around 50.0151. And silver being down 2.6% while gold is down only about 0.6 tells you this.